Hello aspirants and welcome again to Legacy IAS Academy. In this session, we'll be continuing with our revision of Indian economy's current affairs and we'll be seeing for the month of December 2024. So let's see what's in store for this particular month. Before that, let me tell you that this entire series of current affairs revision is happening for the entire 1 year, of course, for all the subjects that are there. So very important for your 2025 prelims exam, and of course brief notes will also be provided to fasten the pace of your revision. Now let's see what are we going to cover over here. The first thing is the GDP base year revision. So what is a base year? To what year is the government looking to revise it? We'll see that. Then the Banking Laws Amendment Bill 2024. What are the changes that is being proposed here? Then you have the Most Favored Nation clause. So what is this particular clause and why is it in news? We'll see that. Mag Bridge project. We'll see the Mag Bridge project, who's a part of this. Then we have the 55th GST Council meeting. So what changes were proposed in this particular GST Council meeting? We'll see that. Then you have the All India House Price Index. So any index we see, we'll see who brings it up, what are the key findings of this index, so on and so forth. Similarly, the Consumer Confidence Survey index of 8 core industries. Very important. The 8 core industries are very important. You should know which are they, which is the topmost, which is the bottommost, so on and so forth. Then you have the World Bank, which has released annual international debt report. So what is this report talking about? What are the key findings? Then you have the Tax Justice Network, which released the State of Tax Justice 2024 report. And finally, the Global Wage Report released by ILO, that is International Labour Organization. So before we dig into this news specifically, let me also remind you about the impact program, which is specifically for your mains. It is the intensive mains practice and content training, which will provide you comprehensive answer writing practice, content enrichment sessions, and the most important thing, as I always say, the personalized feedback and mentorship. It is there for all the GS subject as well as essays in over 50 plus hours of live classes consisting of 34 sessions. So I hope all of you are a part of it to gain the benefit. So now let's get started with all the news that I mentioned in the index. So the very first is the GDP base year revision. So what is the news all about? The news is about the revision that is being proposed. That is, the GDP's base year is being proposed to be shifted from 2011-12 to 2022-23. This revision is proposed in the base year. So what is actually the base year? A base year is basically a reference year. Now you take a reference year, you take the prices of that reference year to calculate the real GDP. So why is this coming into picture? Because GDP can be calculated in two ways. One is, or two types of GDP can be calculated. One is nominal GDP, one is real GDP. When you calculate nominal GDP, you do not account for inflation. You let the inflation be a part of it. So in nominal GDP, basically you calculate the GDP of a particular year based on the prices of the same year. Then the GDP so calculated is the nominal GDP. Then what is real GDP? Real GDP is a GDP of any particular year which is calculated based on a specified base year. Clear? Then what happens is the inflation gets accounted for, and what GDP you get is actually the real GDP and not the nominal GDP. So this base year acts as a reference year whose price you take into account while calculating the real GDP. Now, next, so that is all about. So we should know that it is about to change and what real GDP is, nominal GDP is, and the base year. Now, next is the Banking Laws Amendment Bill. Now, the Banking Laws Amendment Bill was passed by Lok Sabha. Now, this bill basically is trying to improve the governance standards in India's banking system. Generally, remember that. At the same time, we should also know what all the acts it proposes to amend. So, it proposes to amend, number 1, the RBI Act of 1934. Number 2, the Banking Regulation Act of 1949. Number 3, the State Bank of India Act of 1955. And next, Banking Companies Acquisition and Transfer of Undertaking Acts of 1970 and 1980. So these are the acts that it proposes to amend. Very important for your prelims exam. Now, What are the key provisions of the bill? The very first thing is the definition of fortnight cash reserve. So when you're talking about cash reserve ratio, statutory liquidity ratio, all these things are checked every fortnight. So what is the definition? And various other things would be done fortnightly. So you need to know what fortnight is. Fortnightly generally means 14 days. But what happens is, if a month is of 31 days, then what happens? One fortnight from 1st to 14, the second from 15 to 20, 15 to 28, then the next will happen from what, 29 to the 12th date of the next month. So what will happen? There will be no consistency or uniformity, as a result of which there is a proposal to change the definition of fortnight. And what is it going to be? Fortnight for cash reserves to be redefined as either 1st to 15th. 1st to 15th, we are including 15 days over here, even though fortnight is of 14 days or 14 nights, and or 16th to the last day of each month. So if it is February, not having a leap year, it is 16 to 28. If it has a leap year, 16 to 29. If it is January, it is 16 to 31. If it is, let's say, April, it is 16 to 30th. So what will happen is, uniformity means every month is going to get over in 2 fortnights. No month is going to have more than 2 fortnights worth of data in it. That is why the uniformity will be coming up. Second is substantial interest in a company. Who is having a substantial interest in a company is decided based on the amount of money that is invested. So if I would have invested, let's say, around 5 lakh rupees, I would have been said to, or 10% of the paid up capital of the company, whichever is less, I would have been said to have a substantial interest in that particular company. Now that definition is being changed, and that 5 lakh rupee limit has been increased to 2 crore, with of course revision possible via notification. Means what? If the government wants to revise it, revision can be done. For that, amendment may not be required, just a notification should be enough. So presently, what is the change? From 5 lakh, it is going to 2 crore rupees. Next is Investor Education and Protection Fund. This particular fund will be created out of the money, the shares, the dividends, etc., which has not been distributed for 7 consecutive years. That kind of money, if it is still left untouched, unused, that money is going to go into the Investor Education and Protection Fund. This fund will be utilized to educate and make the investor aware for their benefit. Then you have remuneration of the auditors. Now the remuneration of the auditors can be decided by the banks themselves. This amendment is empowering the banks to decide auditors' remuneration. Earlier, what was the case? The RBI central government consultation was required. Now no further such consultation will be needed. Bank will be empowered to remunerate the auditors as they like to. Next is the most favored nation concept. Why is it in news? It is in news because starting 1st January 2025, of course the news is of December because this news came in December, but the implementation was to be started from January 1st, which has already started. So starting 1st January 2025, Switzerland has suspended the most favored nation tag or the most favored nation clause in the double taxation avoidance agreement that it has with India. So what is this most favored nation tag? See, what happens is, let's understand this with the help of an example. So let's say the first country A is our country India. Now India has a tax treaty with, of course, Switzerland, country B, that is Switzerland. Now under this tax treaty, they have also given each other the most favored nation tag. Most favored nation tag. And initially the tax rate between the two with respect to the trades and goods and services is, let's say, 10%. So let's say there is a particular commodity X which is being traded. So when that particular commodity X is traded, the amount of tax that Switzerland will impose on such exports from India is around 10%. But what happens later on, let's say Switzerland comes into, or here the example is of India. So let's say India comes into an agreement with another country. So India, that is country A, signs a treaty with another country, country C, that is France in this case. And with France, we have an agreement that the same product X, we will charge only 5% of import tax duties. For example, France will charge us 5%, we will charge France 5%. Now the same product X is being charged at only 5% to France, right? So when France also sends their exports to India, we will charge only 5%. But if Switzerland was sending, we were charging 10%. Their contract was meant 10%. Now the moment we sign a treaty with another country, in this case France, and say that they will be charged only 5%, then what happens? This 10% for Switzerland automatically reduces to 5% automatically. Why? Because Switzerland is one of the most favored nations. MFN tag is there. That means if India has an MFN tag with any country, then the taxation rate with respect to that country cannot be higher than the taxation rate with respect to any other country. If India goes into a tax agreement with another country, D, let's say USA, and says that we will tax only 1%, then automatically this tax rate and this tax rate will further come down to 1%, because there can be no nation more favored by India than the MFN tagged nations. Right? So this works both the ways. Now Switzerland is said to have suspended this most favored nation clause. I hope that is absolutely clear. Next is the Project Bridge. Project M Bridge, sorry, Project M Bridge. Now, or you can say this, the project is like a bridge because it will provide certain facilities. We'll see that in detail. So Bank for International Settlements has said that the Project M Bridge has reached the minimum viable product stage. Minimum viable product stage means now it has reached a stage wherein on its own it is going to be viable. Minimum viable product stage it has been reached. It was launched in 2021, and what is it? It is a cross-border decentralized multiple central bank digital currency platform. So of course it is a platform which acts as a bridge for transaction among different countries or the central banks of different countries. Now who are the participants? Initially, of course, it was led by BIS Innovation Hub, that is Bank for International Settlements Innovation Hub. It was in collaboration with 4 central banks, of which countries? China, Thailand, United Arab Emirates and Hong Kong. Fine. Then Saudi Central Bank joined in 2024. Now presently as we speak, there are more than 31 observing members, including Reserve Bank of India. So is India a member? No, India is as observing member. Basically India is an observer. This is present status of India. Now, with respect to Bank for International Settlement, it was created in 1930 at the Hague Conference. Remember it. Now, the thing is, the question that can be asked is, Hague Convention led to the formation of what? So, it led to the formation of BIS. So, what is its mandate? Its mandate is to support central banks' pursuit of monetary and financial stability through international cooperation. So, see, it acts like a regulator for the central banks of the world. Like RBI acts as a regulator for the banks in India, in the same manner BIS tries to act as a regulator for all the central banks of the member countries. Okay? So act as a bank for central banks. So acts as a central bank for central banks of different countries of the world. It is owned by 63 central banks, including Reserve Bank of India. Now these 63 central banks coming from about 63 countries, but the GDP share of these banks or these countries is more than 90%. So big countries are of course involved over here. That has to be remembered. Moving ahead, 55th GST Council meeting took place. Right, what is GST Council? It takes into, whatever the GST rates are changing, you are getting exemption, changing from one rate to another, all these decisions are taken by GST Council. All right. Now this 55th meeting took place. Now in this meeting, what all the important things were? Number one, full exemption of GST on gene therapy. So if gene therapy is there, there is full on exemption of GST. Exemption of GST on contributions by general insurance companies. So whatever general insurance companies are contributing from third party vehicle premiums for motor vehicle accident fund is GST free. Basically there is exemption. Then you have reduction in GST rate on the fortified kernel. So fortified kernel is there. The rice, the variety of rice, the GST on this has been reduced. Then with respect to pepper, any kind of pepper, whether it is fresh green or dried, and raisins, when it is supplied by an agriculturalist, it is not liable to GST. So if I say that pepper, dried pepper is not liable to GST, it is. But when it is supplied by an agriculturalist, at that time it is not liable for GST. Next is popcorn. Now there is a kind of popcorn, the caramel popcorn, which is a sweet popcorn. It is sweet in taste. So if you talk about that sweet caramel popcorn, it would attract 18% of GST. So when popcorn is mixed with sugar, so caramel is one such example of popcorn which is mixed with sugar, because caramel is sweet. There can be other sweet flavors as well. So the criteria is, if it is mixed with sweet sugar, then it will attract 18% GST. And recently also cakes have started attracting 18% of GST. I hope that is absolutely clear. Going ahead, All India House Price Index. So Reserve Bank of India has released All India House Price Index, that is HPI. This index has shown that there is an increase in the house prices. HPI has increased by 4.3% year on year in Q2 of 24-25, up from previous year's 3.3%. So not just that it has increased, but the rate has also been on the higher side. Now if you look at it, Bengaluru has seen the highest growth at 8.8%, whereas Kanpur has seen a decline by 2%. That means minus 2% rate is there. Now, more about the All India House Price Index. The base year is 2010-11. The base number or the unit is around 100. What is the data source? Transaction level data from registration authorities in 10 major cities. There are registration authorities, registrar's office. So from there, you can get the data as to how much amount a particular property was sold, bought, etc., which will give you the prices. So it is there taken for 10 major cities, which is Ahmedabad, Bengaluru, Chennai, Delhi, Jaipur, Mumbai, Lucknow, Kolkata, Kochi, and Kanpur. And in that, remember, Bengaluru has seen the highest growth, whereas Kanpur has seen a decline by about 2%. Next is Consumer Confidence Survey. Now this survey is done to check the confidence of the consumer. However, this latest survey, which was done of course by the RBI, it has revealed that there has been a weakened consumer confidence in India's economy, employment and spending. Means India's economy means with respect to the growth rate. India's employment situation means whether the employment is properly available or not, unemployment rate is high, low. In that scenario, the confidence is weak. That means Indian consumer are not quite confident enough in the Indian economy to provide proper employment, at the same time with respect to spending as well. Right. So this particular consumer confidence survey is an indicator reflecting the optimism or pessimism. Optimism means positivity, or pessimism, which means negativity about the economy and the personal finances of an individual and the nation at large. So the Reserve Bank of India measures it through a bi-monthly CCS, Consumer Confidence Survey. Bi-monthly. So every 2 months this survey would be done. Now this CCS, Consumer Confidence, is measured through two different indices. The very first is the Current Situation Index. So what is the current situation index? It talks about the consumer sentiment about economy, employment and prices compared to a year ago. So as compared to the previous year, how confident you are with respect to these things presently. And then future expectation index, that is expectations about the economy, employment and prices a year ahead. So it is the same criteria, but a year back, with respect to a year back, how do you feel now and what are your expectations from the coming year is what it talks about. Next, very important, index of 8 core industries. So index of 8 core industries has been released and it shows that there is an increase by 3.1% in October 24 as compared to October 2023. Now, what is this ICI index of core industries? It measures combined and individual performance of production of 8 core industries. So what are these 8 core industries? Refinery products, then you have steel, coal, crude oil, cement, natural gas, cement and fertilizer. I'll repeat: refinery products, electricity, steel, coal, then crude oil, cement, natural gas and fertilizer. Now this is also the arrangement from highest to lowest. So highest is refinery product, then you have electricity and then steel. Lowest is fertilizer. At least this much you should know. At the same time, these entire industries, that is index of core industry, is about having a weightage of 40.27% of weightage in what? In index of industrial production. So IIP, which is index of industrial production, consists of these 8 core industries, and these 8 core industries forms about 40.27% of index of industrial production. Next is the annual international debt report. Now this report is released by World Bank. So World Bank releases a lot of reports. One is Be Ready Index, which we have seen in the previous compilation. This is also released by World Bank, annual international debt report. Now it features what? The external debt statistics and analysis for low, and this is important, for low and middle income countries, that is LMICs, that report to the World Bank's debtor reporting system. So does it take into account all the low and middle income countries? No, only those countries which report, only those low and middle income countries that report to the World Bank's debtor reporting system. So UPSC can just remove this particular point and say that all the low and middle income countries are included. That will be false. Only those low and middle income countries that report to the World Bank's debtor reporting system. Now further on this report, there is a rising external debt that can be seen. Total external debt for LMICs have rose by 2.4% in 23, reaching to $8.8 trillion. So one thing is important is that it has increased. What are the factors that are driving indebtedness? That is high interest rates. Since interest rates are high, a lot of money goes into payment of the interest of the loans, of the borrowings, of the debt that has been already taken or is being taken. It plays a very important role. Next is State of Tax Justice 2024. So Tax Justice Network, this is the organization that has released the State of Tax Justice Report 2024. Now what does the report do? It highlights the tax losses due to global tax abuse. So what is global tax abuse? Global tax abuse are different ways of abusing the tax laws in order to ensure that you end up paying no or very low taxes. It is, for example, siphoning off your money through tax havens, showing let's say, if you talk about the example of India, in India you can show certain income as agricultural income instead of income from other sources, and when you show agricultural income, as you know, agricultural income is not taxable, so you can be exempt from taxes. Now these are all illegal ways to do it. It is punishable, of course, by law, but people still do it. So this report has highlighted that since global tax abuse is ongoing, as a result of which a lot of tax is being lost, right? Now countries are losing around $492 billion a year to global tax abuse. Now out of this, 2/3 is lost to multinational corporations shifting profit offshore to underpay the taxes. For example, even Apple does that. shows that its income is being generated from another country that is a tax haven country where taxes are not high, so it ends up paying very low taxes. Remaining 1/3 is basically being lost to the wealthy individuals hiding their income offshore. So 2/3 is hidden by the corporates and 1/3 is hidden by the wealthy individuals. Next up is Global Wage Report. International Labour Organization, that is ILO, has released the Global Wage Report. Now it provides the detailed look at wage trends across the globe, highlighting changes in wage inequality and real wage growth. Now this real wage growth is very important. See, your wage can increase by 10% per year, for example, but if inflation in that year was 10%, so what is the real growth of your income? It is literally zero. So it talks about the wage growth, but what kind of wage growth? The real wage growth, not the nominal wage growth, and also sees the changes in wage inequality. So what is the outcome of this wage report? Global wage report is that after falling in 2022, global real wages have recovered in 2023. So from 2021 to 2022, there was a fall, and now again a recovery is there. Now average wages are increasing faster in Asia, the Pacific, the Central and Western Asia and Eastern Europe compared to rest of the world. So majorly in Asia and Eastern Europe, what is happening? The average wages are increasing as compared to the rest of the world. Now if you look at the trends in labor income inequality, you can see there is wage inequality. It has witnessed declining trend globally. So wage inequality exists, means there are people doing the same job but being paid differently. For example, gender pay gap or inequality in wages due to gender. So all that related inequality in the wage is seeing a declining trend. Does that mean that inequality in wages does not exist? No, it does exist, but there is an declining trend. However, having said that, wage inequality is highest in low income countries and lowest in high income countries. So that is one thing which needs to be addressed. Now, when you talk about informal economy, another finding of it says that women and workers are women as workers are overrepresented in the low end of wage distribution. So the jobs which are low paying jobs, women are overrepresented in such jobs. Now, next up is, just a minute. Yeah. Next up is one more information that has come out, that employment has increased in absolute terms due to insufficient formal job creation. Now, it looks like a contradicting statement, but what is this statement trying to say? Informal employment has increased in absolute terms, right? Why informal is increasing? See, there is an issue of formal job creation. Understand this. This is talking about two different things which needs to be very clear. Informal sector, informal employment has increased in absolute term. Which kind of employment? Informal. But what has happened to the formal one? Basically there is insufficient formal job creation. So since there is insufficient formal job creation, informal employment has actually increased over here, is what the report says. Now another side of this thing can be, or another angle over here can be, see what is happening is, now the jobs which were earlier in the formal sector are now becoming in the informal sector, or let's say, people are not wanting to shift to the formal sector, you can say. There is a reason for that. Let's say you are a company of 9 people, right? Now the moment you reach 10 people, you have to register yourself. There will be rules, regulations, guidelines, this, that, etc., etc., which will be a cost to the company with respect to time and money. So the company is generally reluctant to convert it itself into the formal sector. That's point number one. Point number two, the taxation system is also there. Generally, people remain in the informal sector, take money, take fees, etc. in cash in order to avoid taxes, so on and so forth, as a result of which they want to stay in the informal sector. So these informal sector could have converted into formal sector, and the statistics might have been at least slightly different. So that is another reason. So it is not just that there is insufficient formal job creation. This is there is no doubt about it. Why? Because informal economy is taking care of a lot of things already, as a result of which formal jobs are not being created. So that is one. This particular analysis which I gave you is going to help you in mains as well. But as a finding of the report, you should clearly remember that informal employment has increased. It has increased in absolute terms. In absolute terms means in numbers. It is not talking about increase in the percentage or increase in the growth rate, etc. It is talking about absolute terms. So earlier, if it was 100, it has now become more than 100. That is the simple explanation of increase in absolute terms. Then you have labor productivity for the period of 25 years, that is 1999 to 2024. It says that this has increased more rapidly in high income countries than the real wages. Very important and interesting thing, because here they are comparing two things. They are comparing the productivity and the real wages. So productivity, they are saying, is growing at a faster pace than the real wages. So the laborers, the people, the employees are doing more for the company. Productivity is increasing, but the real wages is not increasing, is what the report says. So real wage should increase. It means that with every passing year, we are doing more and more work. This is the report this is the data for the last 25 years. More efficiently, more productivity. Each individual is having a higher productivity. The rate of growth of this productivity is higher than the rate of growth of real wages. I hope that's absolutely clear. So this was all about December 2024 current affairs. In the next session, I'll see you with January 2024 current affairs. Thank you.